Howdy, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, November 27th, 2023. As always, we'll start with the executive summary from our leadoff morning note. As always, if you would like the analysis supporting these conclusions, as well as what to actually do about them in your portfolio, obviously you need to be a client of 42 Macro. So number one, recall that the top-down market regime transitioned to Goldilocks on Friday. Goldilocks is a risk-on regime in which investors are generally rewarded for increasing risk. Number two, our proprietary study of conditional seasonality did not yield any major concerns for investors that are ill-positioned for a continuation of the nascent Goldilocks top-down market regime. Specifically, our analysis of nearly a century of monthly S&P 500 returns suggests dips are likely to be bought over the next couple of months. And number three, these are the key portfolio construction considerations in Goldilocks. High beta tends to outperform low beta. Growth tends to outperform value. Mega cap growth tends to outperform dividend compounders. Spread products tend to outperform treasuries in the fixed income market, and high yield tends to outperform investment grade. Transitioning here to my Longbow dashboard, we'll give you a quick rundown of what's happening in global macro. So in terms of the trading range signals here from our friends over at Longbow, we have an oversold signal here in the Shanghai composite there. So just be aware of that if you are looking to scoop up some Chinese equities. Obviously, the policy mix continues to be quite favorable for taking risk in Chinese risk assets, but that we have not seen much of a market response. Perhaps we will see one at the beginning of next year as Beijing typically front loads fiscal and monetary support for the economy. And then we also have a oversold signal here in agriculture here. So for those of you who've been trading the commodity space, ag is certainly something that could work in a Goldilocks regime, albeit you're going to find better returns in things like equities and credit and maybe even digital assets like Bitcoin, Ethereum, etc. Transitioning to a question before we wrap up. So we got a question from our community. So for those of you who are not subscribers of 42 Macro, one of the ways in which we help retail and RA investors manage their portfolio risk is through our proprietary KISS portfolio construction process. That's a 60-30-10 trend following approach that's designed to outperform your standard 60-40 portfolio, 60% stocks, 30% fixed income, 10% Bitcoin. And we use a variety of sophisticated quantitative tools to risk manage those positions to make sure that we're maximizing upside capture and minimizing downside capture in that process. So I'll read the question here. It says, when KISS indicates an allocation change, is that a full scale in or out like at the start of next week? We typically publish updates to KISS on Saturday and our weekly around the horn portfolio, or intra-week as well if there's a big change intra-week, but typically those are coming out on Saturday. So going back to the question, when KISS indicates an allocation change, that is a full scale in or out, is it at the start of next week, or is it signaling dollar cost average based on the ranges like in the past? So in terms of we've constructed very careful, very deep out of sample back tests for our KISS portfolio construction process, and no surprises, it's demonstrably outperforming 60-40. It has much better volatility characteristics, much higher Sharpe ratio, Sortino ratio, etc., than just being long 60-30-10 Bitcoin on a raw basis. And so that sample back test shows that when you perform the pivots that KISS is signaling to pivot, signaling to make on a one-day lag to the receipt of the signal, that's what the back test shows. So to answer the question, you typically not the back test suggests that you're not going to want to be too delayed in responding to signal-based changes in that systematic process. Obviously, some investors may prefer to dollar cost average. I generally think dollar cost averaging is a good idea, particularly for retail and RA investors. I think a lot of folks who don't have Bayesian research processes where they're constantly receiving, thoughtful quantitative signals on what to do today. Now, a lot of folks get really just whipped around by the evolving narratives out there, particularly on the qualitative research front, i.e. what's going to happen in growth, what's going to happen in inflation, what's going to happen in policy. A lot of folks spend way too much time overweighting those factors and way too little time on overweighting what's actually happening in the market and what the highest probability outcomes are based on different market dynamics. So I think we do a great job of both here at 42 Macro. Hopefully you guys check us out. But if you don't want to check us out, we'll catch you back here tomorrow. Everyone have a great day out there. Cheers.